We are in the age of electrification. Not only are we transitioning to renewables, the demand for power from data centers is rising substantially. We are honored to have James Whiteside from Wood Mackenzie to discuss all this and more. Welcome to the Commodity Exchange, a podcast where we bring to you insights from the world of commodities. Whether you are an investor or just want to learn more about the topic, this is the podcast for you. So, welcome, James. Tell us a little bit about yourself and Wood Mackenzie, who you work for.
Thanks, Nitesh. So James Whiteside, I'm head of corporate research for metals and mining at Wood Mackenzie. I've worked in the metals mining industry since starting out, building gold mines in different parts of the world, weird and wonderful parts of the world, over 15 years ago now. I've been with Wood Mac for about 10 years. Wood Mac, for people who don't know, the company, we're an energy and natural resources research and consultancy house. So within the company, I lead our coverage of metals and mining companies. Really happy to be here on the podcast and joining you today.
Excellent. No, we're really happy to have you. And for full disclosure, Wood Mackenzie work very closely with Wisdom Tree, who I work for, in a number of energy transition type of strategies. So we do learn a lot from Wood Mackenzie, and I'm glad to help to bring their expertise to our audience here on the podcast and to our clients. So, James, the electrical intensity of GDP had been declining for decades in Europe and US, but that trend seems to have reversed a little bit in recent years. Can you tell us a little bit about what's driving that shift, and do you think that will continue?
Yeah. Electrical intensity of GDP. What do we actually mean by that? I guess it's a way to look at the relative growth of electricity demand to the rate of growth in the economy overall. And you're right, like it's definitely decoupled those two things in the developed world over the last 25 years. If we look back to 2000. And electricity demand has basically flatlined in the EU and the US, and that's typical for economies that are services rather than manufacturing led in terms of their growth. But in the last couple of years, we have seen a recoupling. So electricity demand starting to outpace GDP growth. And what's driving that? So what we think about there is electrification, the rise of data centers, and the energy transition overall. The economy is becoming more electrified, and that shift that we're seeing towards electrification and higher electrical intensity of GDP growth, that's driven by technology and not just government policy, which is often one of the things that's sort of seen as a weakness in the energy transition overall. And that is the thing that will drive and fundamentally shape the mining cycle going forwards. So yeah, it's a major trend for metals mining.
Yeah. So you mentioned the buzzword, data centers. That does seem to be generating a lot of excitement in this energy, in this increase in power demand. And as you say, it's delinked from, policy moves for energy transition. Um, what are your expectations around that? How much can this grow, and from what base? And where do you think that that market will go? The data center energy demand.
Yeah, well, I'm quite surprised when I look at these numbers, really, how big it is already. So 500 terawatt hours. Maybe that needs putting into context. It's a big number, and it's roughly the same size as used in EVs today. And our expectation is that number, the electricity consumption of data centers will grow ninefold by 2030, and it will be 4% of global power demand by 2030, going all the way to 8% by 2050. And what we're seeing is it's not just in the US, it's becoming more global. Um, Part of that is driven by uh, different governments prioritizing data sovereignty, fueling more of a global boom, and the emergence of DeepSeek. We saw a month or so ago. Um, Initially, quite a small, innovative AI startup. It's kind of expanded very rapidly within China, and that will sort of, in our view, accelerate the globalization of AI and the build out of data centers. So, that base case that I talked about, we could accelerate beyond that, given this sort of democratization of AI.
Wow. So it's data center demand for power is already bigger than EV demand, and by 2030, when it's grown ninefold, how much larger would it be than the EV market by then?
It's gonna be a little
Wow.
under double the EV market.
Wow.
Um, so yeah, I mean it's pretty huge when you think about the strain that EVs are already putting on some grids.
Wow. That is very impressive. And so, which source of energy do you think will most benefit from this rising electricity demand across the board?
Yeah, so I mean, um, when we were looking at the US in particular
Hmm.
and thinking about big tech and their commitments to AI, they they sort of the number that's put around is $300 billion this year in capital investment in data centers, and that's what the companies themselves are telling us they're going to put into data centers. Those companies, talking about Apple, Amazon, Microsoft, Meta, um, Google, all of them have very strong sustainability commitments. Some of them committing to 100% renewables this year. Some of them committing to net carbon negative by 2030. So they're looking for renewables as the source of power for their data centers. Um, so yeah, for those, renewables not only provide sort of that sustainable low carbon electricity, but it also provide a bit more certainty to their power sourcing. So it's, you know, although you've got the obvious fluctuations in wind and solar, um, you do at least with storage, and perhaps coming in at a later date, nuclear. We saw a lot of action in nuclear last year with SMRs being talked of, restarts of US US generation. It's sort of been curtailed for quite a while. Um, it was set to be all renewables. That said, when I'm thinking about sort of the global picture now, um, other countries will not be as restricted, let's put it that way, in the sources of generation. And actually, last year, we did see sort of increased gas demand in the US, a lot of um, other power generators looking at sort of curtailed thermal generation capacity as well. Um, so, I mean, the scale of demand that we're seeing, although um, sort of intentions may be very good, um, it's going to take everything we've got, essentially. Um, the growth in power demand, um, will require everything.
Yeah. Well, that's really interesting. I mean, especially I guess with these small to medium reactors as SMRs, um, there is that ability to be somewhat a little bit off grid, right? Have a specific um, energy production facility for that specific data center. So, there is almost like full control, I guess, by the data center provider.
Yeah, that's it. So, you know, these data centers are going to be operating for decades, and they want to be sure that the main cost driver for the business is fixed. So, having that dedicated off-grid supply is really essential for them.
Mm. And so a lot of these technologies we've talked about for electricity production, but in particular some of the renewable ones that are part of this energy transition are likely to drive metal demand higher. Um, can you walk us through your expectations for metals and which power sources will have the biggest impact on them?
Yeah. Um, so, I mean, first thing to say is it's across generation, transmission, and storage,
Mhm.
and then end use as well. Um, so one of the stats that we often quote is offshore wind needs up to 15 times more copper than a coal-fired power plant. So that's just gives you an idea of the scale of increasing in copper intensity from generation.
Mhm.
Um, and then when we look at the grid, um, to get to net zero, we need lots more wind, we need lots more solar, we need not lots more nuclear, we need a lot more generation sites, and then the end uses are growing. Um, so the scale of the grid needs to double by 2050, which is an absolutely huge investment requirement. It's a $21 million investment required by 2050, and that will place a huge strain on um, a few commodities, but um, in particular copper and aluminium, which are relatively mature industries. And then you've got battery related demand, which we expect to increase fivefold by 2050. Um, and so a faster rate of growth, um, but in a lot smaller industries, so metals that are less mature and are coming off a much smaller base. Um, so yeah, there's going to be a strain from the demand side on on um, on the metal supply.
Wow, that does sound like a very strong demand bull story. How about looking a bit more downstream? Tell us a little bit about the metal intensity of different car platforms, electric vehicles versus their internal combustion engine equivalents. You know, we always often hear that they're more metal intensive, but give us a bit more color around that.
Yeah, that's certainly right. They are. There's going to be a deeper reliance and a broader reliance on a wider range of metals. Copper. Think about copper in an ICE. It's about 22 kilograms. Can be up to 90 in a pure EV. So what's that, 4 times? And overall, that's what we see in metals in EVs relative to ICEs. It's about 6 times actually once you layer in the battery raw materials as well. Um, and that's you know on the copper side before you get into the charging infrastructure and grid requirements on top of that. So it is a real source of demand for copper. When we think about the battery raw materials, in all batteries, you have lithium, graphite, and silicon. So they're not substituted. Um, there was some moves towards sodium ion at the absolute peak in lithium prices, but that's all been backtracked as lithium prices have come back down to earth. Then in terms of the cathode raw materials, nickel, cobalt, manganese, phosphorus, all in different quantities depending on the chemistry of choice um, that the manufacturer goes for. But yeah, it's absolutely, it's compared to internal combustion engines, it's transformative for metals demand.
Wow. And we talked a lot about the demand. How about the supply? Because pricing is always dependent on both. So and balance is always dependent on both. So um, you know, is there enough commitment to the investment in the mining and refining of all these materials that are required, so that supply can keep up with demand?
Is there enough commitment? I guess you have to look commodity by commodity, right?
Hmm.
So, um, if I can talk generically though, for base metals, um, commodities like copper, aluminium, nickel, and zinc, if we look 10 years out, there's going to be a shortage, um, and relative to current demand projections and our forecasts of supply based on depletion of existing assets, but also the investment pipeline that's there. So we're essentially saying investment isn't going at the right pace to meet demand by um, by 2030, actually. So a lot closer than that 10-year horizon. We're only 5 years away from 2030 now. When we look at some of the battery raw materials, we're coming out of a period of really strong investment, actually, um, beyond beyond really what was required. So, particularly in China, we saw this huge build out of chemicals and upstream um, capacity, and that continues uh, into 2024. So we do have a bit of an overhang in terms of lithium. That said, we're now seeing projects that are in our pipeline coming out. There was just the other day, the Rhyolite Ridge project. One of the partners pulled out of that. That's in the US, one of the places that we would expect to see greater investment at the moment because of the measures that are going on. But even that has sort of hit hit the rails. Um, so yeah, there is a bit of a pullback in investment in lithium, and that's going to be a good thing for the market balance overall. Yeah, so in our forecast, our lithium team um, are forecasting the deficit to re-emerge in the early 2030s. That said, we hit a low point in prices last year, in their view. Um, there have been curtailments, not just on the project side, but also in the assets. So some of the higher cost assets have come out of the market, and that's provided slightly higher level of cost support for for lithium, uh, particularly on the spodumene side. So that's the mined concentrate product.
Hmm.
So that has hit support, and we're now up at about $1,000 a ton. Um, Whereas chemicals prices, uh, carbonate, which is one of the biggest products, is slightly lower than $10,000 a ton. We don't expect it to stay there. We expect both carbonate and the alternative form of um, lithium chemical hydroxide to see some recovery from here over the next few years.
Uh, how about cobalt? Is there any hope for market balance in cobalt in the near future?
Yeah, so cobalt has been a very interesting market over the last few years. Um, we actually hit um, the lowest ever cobalt price recorded in real terms last year. Um, and part of that has been thrifting, substitution in batteries, but also a rapid build out of capacity in the DRC. So it's been hit by both supply and demand. It's really concentrated in terms of supply in the DRC, and we saw the effects of that in the government of the DRC introducing a 4-month suspension in exports. And since then, prices have come back 50%. So the movement's been rapid. And with that, we've seen new investment vehicles being created to buy up lithium, sorry, cobalt um, supply and take it out of the market. So begin stockpiling, and that could drive prices even higher. So I guess with a lot of these commodities, we think about nickel, we think about cobalt. There's the byproduct element for cobalt, but there's also the concentration of supply, and that concentration of supply can cause these risks, which when they eventuate, massive implications on the market.
Wow. So the DRC could be like almost like the OPEC of the cobalt market, right?
Yeah, it just doesn't need anyone to agree with it. It can do its own quotas.
Yeah.
Yeah,
Makes the meetings easier.
it does indeed.
Yeah. So, I mean, we talked about a number of metals where investment has been slow. Um, why has there been a lack of capital expenditure in the mining world?
Yeah, I mean that's a very broad question, and
Hmm.
we really have to go back 10 years almost
Yeah.
to the end of the last China-driven super cycle.
Hmm.
And during that period, mining companies really overspent, and we saw overcapacity coming into the market, and a lot of the mining companies did get into quite a lot of trouble um, regarding their, their their leverage and gearing levels. Were forced to refinance, and with that, they brought in new, more stringent capital allocation processes. So their requirements for returns from projects has increased significantly relative to the last cycle. Um, but also at the same time, what we've seen is the requirements for projects in mining to become broader.
Hmm.
So particularly around sustainability issues, mining companies have to take um, a, a broader view on what is their responsibility in developing new operations. So whether that be water, power, um, societal, local community investment, the capital intensity for mining projects has gone up significantly. So those two things I would put as the primary drivers for the sort of lack of investment in some of these commodities. Um, yeah, in combination, the, it's really the returns on projects that are expected right now. So companies are looking for higher prices, and as long as investment stays lower, and to be clear, it's a lot lower than it was in the last China-driven super cycle, um, then then the supply response will not be forthcoming, and prices will respond accordingly.
Wow. Sounds like you're painting the picture of, it's not just about you know the uh, the IRRs, the returns. There's a lot more other metrics that miners are looking to target. Uh, you know, some social, but others probably a little bit more financial as well. But can you dig a little bit deeper into that? What are the other, I don't know, the sort of financial targets that they have to they're more concerned about at the moment, alongside the more social related things that you already outlined.
Yeah, absolutely. Yeah, digging deeper, no pun intended. We have done a lot of analysis around the project pipeline that's out there and measuring it versus the criteria that mining companies use in assessing new investment opportunities. So we've got the returns, so the IRRs. Typically, actually, it's measured versus the returns they can get from buybacks. But if we were to say a representative level for that is about 15% IRR, actually at today's prices, taking copper, um, almost 2/3 of projects meet that criteria. Copper prices have risen significantly, and expectations for copper prices, both consensus and those used by the companies have increased significantly, to the point that IRRs are justifying the investment in a lot of projects. But when we look at some of the other qualitative criteria, we're thinking about the scale of projects. They have to be material operations. When we talk about the ESG aspects, management capacity to manage those is limited, and they want to focus on the largest, most material projects. So we can screen out. A lot of companies do screen out a lot of the smaller projects, and quite a lot of copper projects that hit that 15% IRR are actually on the smaller side. Likewise, they want projects that will be robust throughout pricing cycles. So when we look at industries overall, the projects that will maintain margins throughout an industry cycle sit in the bottom half of the industry cost curve. So they're the lowest cost producers. So once you take into account that, actually only 20% of projects that are in our pipeline meet mining companies' criteria, and that's before you get into the more sort of qualitative criteria.
So, James, nickel has been in an oversupply for a number of years now, largely due to Indonesia's overproduction. Do you think anything will change that?
So there's certainly risks. When we talked about DRC and the concentration risk on production, we've got to that point in Indonesia now, and there has been a lot of speculation, fueled by the government comments that they are going to reduce quotas on exports for nickel. And more recently, there's been rumours, and again backed up by government statements, that new royalties will come in on nickel production. So that concentration in Indonesia and the risks around both the quantity and cost of production are very real. For now, what we're seeing is, with the level of oversupply, prices are very much at cost support. So we think about cost support being at around the 90th percentile of the cost curve. So what we mean is some of the highest cost producers provide the support, and we've been skirting along that level for a while. We did see some de-escalation, some deflation in costs, which brought nickel prices down. But again, that can change very quickly.
Well, I guess there's a lot of risk to the upside for price. I guess if certain decisions are made.
Yeah, I think quotas are coming,
Hmm.
but not at the level that was speculated at the start of the year. At the start of the year, they were talking about 50% perhaps of last year, and that hasn't happened. There was some talk around actually increasing them. Things can move very quickly in Indonesia.
Hmm. So going back to miners in general, do you think most miners, and that's hard to generalize, obviously, but do you think most miners are prioritizing building new projects at the moment or just acquiring assets from others?
Yeah, number one priority for the major mining companies is managing their balance sheet. And at the moment, they're still at pretty low levels of gearing. So there's a lot of capacity for them to go out there and acquire, using debt, well, cash and debt, essentially. Likewise, when they look at sort of their pipeline of projects, because they haven't been investing for the last 10 years, and the lead times for new projects, their pipeline and ability to deliver new capacity is relatively limited. When they look at those projects relative to acquisition opportunities, the costs of delivering new capacity is actually cheaper in many cases for buying an existing producer rather than building a new mine with the lead time associated with that. So we have seen a preference for buying over building, and we expect that to continue as many of these companies are still sitting on quite a good um, quite a good balance sheet, which equips them to go out there into the market and make acquisitions.
Mm. And so we talked a lot about metals, but what about rare earths? What are the key themes in rare earths, and where do you think you see the big upside and downside risks? And I know rare earths are a diverse set of things, and it's hard to talk about it in general terms. But maybe some of the biggest rare earths, like neobitum. Am I pronouncing it right?
That's as good as I,
Yeah.
that's as good as you're going to get because I'm not going to do any better.
Yeah.
Neodymium.
Okay.
Yeah, I'd go for neodymium,
Okay.
and you're right, like neodymium, praseodymium. Those two are the sort of heavy rare earths, and they're the magnet rare earths, which are really the drivers of revenues for rare earths producers and the ones that companies want to produce. And yeah, just for context, where are these used? Why are they important? Um, Electric vehicle motors, making permanent magnets to make those motors more powerful, and also in wind turbines for generation as well. Um, so a lot of the production, especially downstream, is based in China. Um, and what are the risks there? I guess lower than expected Chinese quotas, particularly as we see like government interventions previously. The government in China is looking to consolidate production domestically, and that may sort of precipitate that consolidation may precipitate a shrinking in supply in the short term. So that's a real risk, and certainly the deterioration if it emerges of ties between Europe, the US, and China may lead to more trade restrictions as well. Um, the Chinese government overall, whenever whenever new entrants have appeared to be entering the market, have intervened to sort of artificially lower prices. So we could see that as well. Um, that said, I do think that there's so much impetus from the West to develop new capacity. They will put in the measures required to um, actually make these projects start to make sense economically, even if the pricing conditions um, go south, essentially.
Mhm. And it does seem in this age of uh, trade tensions, you know, rare earths are getting caught in the crosshairs, right? I think China had put restrictions on germanium and gallium a few years ago, actually now, but um, also
Yeah,
in terms of resource management, I mean, look at Trump's plans for peace in Europe, Ukraine. It involves trying to get access to some of these materials, right? So it's becoming a lot more of a sort of a hot topic in terms of geopolitical tensions.
absolutely, absolutely. Of course, there is room for substitution, and
Mm.
longer term, a lot of the sort of rare earth magnets, uh, the producers of magnets using rare earths are looking to sort of substitute those out. And with the pricing volatility, the supply volatility that's there, longer term, we could see an acceleration in that as well. So that's a real risk that we want to watch out for.
Wow, I guess there's a lot to look out for. Um,
Yeah.
so thank you very much, James, for sharing your valuable insights with us. Please do let our audience know how they can read more of your stuff and follow the things you write.
Yeah. I mean, feel free to reach out directly um, and look at Wood Mackenzie's website, and you can see on woodmac.com all our sort of insights and range of sort of coverage that we have of different commodities and energy markets. So take a look.
And I should add to that, would Mackenzie do often write blogs for us at Wisdom Tree as well, because we'd like to tap into their intelligence on these themes. So you can also come to our website to see some of WoodMac's views as well. But thanks everyone for tuning in. We do hope you've enjoyed today's episode of the Commodity Exchange. If you want to hear more from us, please go at Wisdom Tree. Please do subscribe at whichever platform you're using. You can follow me on X, formerly Twitter, with the handle at Nitesh Shah WT. And if you want to learn more about commodities, please do visit Wisdom Tree's website, where we have a wide range of research material and insights. But before I conclude, I just need to say, to clarify, the views and opinions expressed in this podcast are those of Wisdom Tree and Wood Mackenzie, and are subject to change. Anything we present on this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not recommendations, offers, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. Until next time, thank you.
Thanks, Nitesh.